Jack, welcome back. Beginning of March. What's happening in the markets?
Well, the main focus of the markets at the moment is the strong US dollar, which is really caused by the strength in the US economy and the expectation that's going to result in rising interest rates, probably in June, if not June, almost certainly September. Now that's really causing ructions around the world in many ways. Firstly, in the US, it means that lots of large cap stocks, people suddenly realized those companies make a lot of their profits outside America, and when they translate them back into US dollars, there'll be less profit. So as a result, people are thinking growth, EPS growth for large cap US companies is going to be less than they're expecting. So that's flowing through into the stock market.
So if the economy is stronger, surely it's only a matter of time before interest rates go up.
I think that's for sure. We've always said we expect it to be June this year, and if not June, September, and that's still our position. And I think the problem is not the impact of the rising interest rates on the US economy, it's the impact of the rising US dollar on US corporate profitability.
And where do you see Europe? Because Europe's in a very different situation. Only this morning we saw a further reduction in interest rates in Europe.
Yeah, the thing about Europe is that the economy is already showing tentative signs of recovery, and they're introducing quantitative easing. The European Central Bank is going to start buying government bonds, and so in a sense there was a small fire, and they're going to throw petrol on it, which should be good for European markets, which of course are also enjoying the benefit of a weaker euro, which means higher profits from their overseas operations.
So where are the risks in these? So you're seeing opportunities in the US and you're seeing opportunities in Europe. Where do the risks lie?
I think the risks are probably for large parts of the emerging markets. Lots of the emerging markets still have a currency that's more or less tied to the US dollar, with the obvious case being the Chinese. And so we're seeing weaker data in China. We're seeing a lot of concern about the process of China switching from an investment economy to a consumption economy. At the same time, the export engine may struggle if the renminbi, the Chinese currency, appreciates against lots of its export markets like Europe and Japan and obviously Australia.
And overall with China, do you believe their growth rates? Is there a hard landing going to arrive in China?
Look, with these fast-growing emerging markets, it's a problem for the economy is not going into a recession. A problem is a slowing growth rate, because the entire economy is set up for constant expansion. So, for example, banks lend money to companies, assuming a certain level of growth. If that growth doesn't materialize, even if they're still growing, doesn't materialize at the level they're expecting, then companies can find themselves over-levered.
So that's the overall position. How do you position the fund to take advantage of the opportunities and to avoid the risk?
Okay, so the first thing we've done is we have reduced our exposure to the US stock market a little bit, and increased our exposure to Europe, particularly to Germany, where the export model I think will work. We've increased our exposure to Japan a bit. We are trimming our exposure to China. We started the year a little bit more optimistic than we are now in China. India, we were maintaining an overweight, and the rest of the emerging market complex we've basically got very low exposure to. For example, we had some exposure to Turkey. We've completely cut that, because no matter how well the stocks do, it's going to be a struggle to keep up when the lira has fallen like a stone.
Jack, thank you very much. Look forward to speaking to you again next month.
Thank you.